Now, Zurich Insurance Group AG is a Swiss-based insurance holding company. It has a market cap of $45.4 billion, trades on a PE of 13.9, dividend yield here of 5.9%, and that is going to be a common theme. These are good dividend players.
Yes, they tend to be.
They tend to be.
The bigger ones are more mature, as we discussed, and as a result, they run their capital very carefully, and it really is about a return on capital, and they run it very carefully. But as a result, they tend to pay out. They're fairly profitable, these businesses, high returns on capital, and as a result, good dividend payouts and good dividend yields.
Now look, to get the international perspective, in the past we've talked about Berkshire Hathaway because they own Geico, but we decided to go with a big European insurer this time simply because they're also enormous, and as you can imagine, they're involved with a whole gamut of stuff. And this is an interesting company because the share chart over the last 5 years,
it went up and then disappeared very quickly.
Yeah, it went up and it then came down. If you go back even further, the all-time high for this stock was in 2007, and then understandably the global financial crisis rolled in. They were subject to lots of losses due to various problems at that time. Since then they've sort of rebuilt.
Can they go back, and this is I suppose what we need to ask Lance, is whether they can go back to their 2015 highs.
The 2015 high, this is a Swiss franc chart because this thing is listed in the market over there in, what's that city called? Zurich.
In Zurich.
I was about to say Vienna, that's the wrong country.
That's in Austria.
They were at 345 Swiss francs a share in 2007. So they've done quite a lot of recovering. They're currently sitting, as you can see there, 286.
286. Lance, is there potential to enjoy upside given where it's come from?
No, I don't think so. It's really a mature business. It's very well established in the developed world. It's well known. It sold its South African interest last year to Fairfax, which is a big Canadian insurance group. So it seemed to be pulling out of the emerging markets where you would maybe see some growth and focusing on its core markets. North America, South America, Europe, and Asia. That's where it's focusing on. So a mature business. These businesses are tied to a certain extent to the fortunes of the capital market. As you can see, as Paul said, 2008 really getting hurt, not so much from the insurance results, but more from the capital side. Significant losses on the capital account. And they have these two parts to it. But this is a mature business. I think a fairly cheap investment, only 1.5 times book. Good returns, very good attractive dividend
and
yields.
it's the dividend yield that you would buy this one for, Paul.
Look, the 08-09 problems were systemic. You know, these insurers inter alia had investments in like Greek bonds, sovereign bonds, and they bought those because the ECB, the European Central Bank, underwrote all of those things. So now that all kind of went haywire.
It unraveled, it would be the right term to use.
Also, of course, in Europe, it's a developed and mature market. Sure, maybe they can get a few more young Europeans to insure their motor cars, one can only hope. Globally, they've still got lots of growth opportunity. They paid a few fines related to misconduct in North America arising out of the global financial crisis.
Can you give me a hot or a not?
I think it's hot. You know what? I just think that it's 10 years on. These companies have learned how to play in the new set of environments and the new set of rules. They're going to be less risky, and their next opportunity is to cut costs.
So hot on
a very
Zurich.
macro call, though, I must add. Not really a...
For the dividend yield alone and relatively good value, not that expensive, I'm hot on this one.
And just reminding you that the dividend yield here, 5.9%.